Bitcoin's value often rises in times of uncertainty, acting as a risk-off asset, offering a hedge against traditional market volatility and economic instability.
I believe it goes up if the world is more frightened, if people have fearful of geopolitical risk, they're fearful of their own risk. It's no different than what gold represented over thousands of years. It is a asset class that protects you.
Right. But others argue Bitcoin behaves as a classic risk-on asset, thriving in times of global liquidity expansion.
If we look at that Fed interest rate cut, Bitcoin is the best performing asset so far. Gold and oil futures are kind of second. There's a new study that just came out from Lynn Alden and Sam Galligan that said Bitcoin is the most sensitive asset when it comes to global liquidity. And so 83% of the time, Bitcoin moves with global liquidity. It's more than S&P or any other asset. And so if you look at not just the interest rate cuts, now M2 money supply is expanding, and also we have cuts going on in China and elsewhere. And so I think that Bitcoin ends up being a big winner whenever we get kind of cheap money flooding into the system.
So which is it? BlackRock has just released a new report on Bitcoin, and here's the narrative they're pushing. A key takeaway from BlackRock's report is how Bitcoin's unique traits, like being non-sovereign and free from political risk, position it as more of a risk-off asset. Let's hear from Robbie Mitchnick, BlackRock's head of digital assets, speaking with Bloomberg to break down why these properties make Bitcoin stand out. But with those characteristics, does Bitcoin face a perception challenge? Many still view it as simply tracking the equity market, but with higher volatility.
I guess, how hard is the sell when you think about the retail investor base that can get into this? If you're trying to tell them it's digital gold, yet the volatility is still so high, and many people don't understand exactly what it is at the end of the day. Is it something that will eventually be used as more payment methods moving forward across different parts of the world? Is it something that you hold and never sell, right? How do you then make that case to a generation of people who have not gotten into this asset?
Sure. Well, when you think about Bitcoin, we think of it primarily as an emerging global monetary alternative, right? It is a scarce, global, decentralized, non-sovereign asset. And it is an asset which has no country-specific risk, has no traditional counterparty risk. So these are interesting properties when you think of it from an investment perspective, particularly in a world where there's growing concerns over money printing, currency debasement risks, political, fiscal, sustainability challenges in the U.S. or elsewhere. And so that resonates, frankly, with a lot of investors. It goes back to what we talked about earlier with the risk-on piece. It confuses investors when people talk about it as risk-on, because based on the properties that I just described, you would think of it as risk-off. And that's where I think
it has a marketing problem.
So you could say that. And so, the reality is there's probably 2 or 3 things a year that happen typically that actually impact the fundamental value of Bitcoin. This year, I would argue there's been 4, but that makes it hard to write daily stories, right? And so you see this instinct to kind of point to whatever's happening in equities or unemployment or jobs numbers or manufacturing, which really has no connection to Bitcoin.
Now, Mitchnick highlights how Bitcoin's lack of sovereign and political risk makes it stand out as a unique asset. But does pointing to external factors like jobs, which BlackRock argues have no real connection to Bitcoin, undermine the very properties that make it different? According to Mitchnick's report, the fundamentals of Bitcoin have been muddled by market commentators.
The narrative around how to think about Bitcoin from a risk perspective has been muddled. And I think it's actually just this amazing own goal that the industry has scored on itself. When we think about sort of crypto market commentary research type notes that exist, our view would be fundamentally Bitcoin is an uncorrelated asset. It has its own unique set of risks that are very distinct, and in some cases probably you could argue inverted versus the risks that stocks and other so-called risk-on assets hold. But for some reason, and I have some theories as to how this happened, I don't think it was intentional. I think that sort of crypto research community has perpetuated and reinforced this narrative that Bitcoin is a risk-on asset. And that's been very damaging and confusing, because a lot of institutional investors, they kind of see and hear the digital gold thing and they get it, and they see that role in its portfolio as a result that's a little bit like gold, but it's going to be more volatile, more risky, higher upside, higher downside. But nonetheless, something that you think about as a potential hedge against money printing, currency debasement, inflation, geopolitical disorder, political, fiscal stress in the U.S., etc. But then, people talk about it. Well, Bitcoin's down because non-farm payrolls came in weak, or the ISM manufacturing index was soft, and they go, "What?" It's fascinating because the industry has taken something that doesn't really have a fundamental basis and repeated it enough times, kind of blindly, that it's starting to actually seep into the narrative and the trading data in a real way. And so now you have to go, is it going to be more driven by what fundamentally makes sense? Or is it going to be more driven by what the narrative is saying?
Mitchnick argues that the misguided narrative, linking Bitcoin's performance to events like jobs reports or non-farm payrolls, has confused investors and damaged Bitcoin's image. By focusing too much on short-term market factors, commentators may be overshadowing Bitcoin's true value, which is rooted in its fundamentals, and instead tying it to trends that typically impact traditional equities. But if that's the case, and analysts like Pomplino, who argue that Bitcoin follows cheap money flowing into the system, are wrong, what examples do we have of Bitcoin showing its negative beta in relation to traditional banking or financial systems? Let's go back to Mitchnick, who points out in the report that Bitcoin tends to perform well during major disruptive events. He specifically highlights the Silicon Valley Bank collapse and regional banking crisis in 2023, where Bitcoin demonstrated its negative beta.
And so when you look at, some of the major disruptive events of the last 5 years, Bitcoin has generally performed very well coming out of those events, but sometimes it sells off at the start because of that reflexive programming to think of it as a, quote, risk-on asset. But then people look at it and go, wait, chaos, turmoil, disorder, potential for money printing, government stimulus, etc., that actually is perhaps bullish for Bitcoin. And then you see the market reaction. If you look at the Silicon Valley Bank and regional banking crisis in March 2023, that was probably the best example of Bitcoin behaving kind of as a hedge, right? Bitcoin was up 30% in the span of a couple of weeks, as fundamentally, would make sense when there's stress in the banking system and fears over that. I think the main reason that was such a clean anecdote for it was the crypto research community didn't have time to screw it up.
Mitchnick even points out that during these downturns, Bitcoin often experiences initial sell-offs, driven by reflexive programming set by traditional crypto market commentators. He goes further to explain that Bitcoin's rapid rise during the regional banking crisis, where it showed its inverted beta, was largely due to the speed at which the events unfolded, preventing market commentators from interfering with Bitcoin's fundamentals. Since we've mentioned beta a few times, let's break it down. Beta measures how an asset moves in relation to the overall market. A beta of 1 means Bitcoin moves exactly in sync with the market, 0 means no connection, and -1 means it moves in the opposite direction. This is important because Bitcoin's low correlation with traditional markets, like the S&P 500, makes it an attractive diversifier. BlackRock's graph shows how both Bitcoin and gold have maintained a low correlation with the S&P 500 since 2015, meaning their prices don't move much in sync with the stock market. This low correlation makes them valuable for investors looking to diversify, offering protection against market volatility and traditional equity risks. Although the graph shows Bitcoin's beta is close to 0, or even inverted at times, BlackRock's report isn't claiming Bitcoin isn't a risky asset. They acknowledge its high volatility but emphasize that its risk drivers are fundamentally different from equities.
Bitcoin is obviously a risky asset.
Okay.
But our view would be it is not a risk-on asset, that risk-on, risk-off framework that exists for traditional finance, and it has its shortcomings, obviously, as well, but it really just doesn't apply to Bitcoin. And so when you try to extrapolate this idea of Bitcoin as a risky asset that makes it risk-on, we would think that fundamentally doesn't make sense.
Mitchnick makes it clear that while Bitcoin has its risks, it doesn't fit neatly into the traditional frameworks used for other financial assets. This isn't just a perspective held by BlackRock's crypto division, it's a view shared by the entire firm.
Is this an alternative in order to be able, because of a deficit, maybe something long-term people should have?
Absolutely. That allows you to have maybe uncorrelated, non-correlated type of returns. I believe it is an instrument that you invest in when you're more frightened, though. Right. It is an instrument when you believe that countries are debasing their currency, debasing their currency by excess deficits, and some countries are. I believe we have countries where you're frightened of your everyday existence, and if you have an opportunity to invest in something that is outside your country's control, then you can have more financial control. And so I'm a major believer that there is a role for Bitcoin in portfolios. I believe you're going to see that as one of the asset classes that we all look at. I look at it as digital gold, as I said before, and I do believe there's a real need for everyone to look at it as one alternative to, I would say, the optimism that I have in the world. If you want to hedge hope, Bitcoin is not an instrument for hope unless you're hopeful you're going to make a lot of money on it. But I look at it as a vehicle in which you're expressing your financial acumen in something that you're more frightened of the world, you're more frightened of your existence. And I believe there's a great industrial use for it. And I think a lot of people are missing that.
Fink also points out that Bitcoin serves as a hedge against issues like the rising U.S. deficit, which has recently hit all-time highs. He highlights how Bitcoin offers more financial control, especially during times of uncertainty and especially for people in countries where their currencies are being debased. It's true that Bitcoin is unlike any other asset, hard-coded to only ever have 21 million in supply, giving it the clearest monetary policy in the world. Anyone can learn exactly how it operates. Its detachment from traditional risks makes it increasingly appealing, not just to retail investors but also to institutional investors and financial advisors. While Bitcoin is still a relatively new asset, it's clear it doesn't fit neatly into the traditional risk-on framework that many market commentators apply. Instead, it's a unique, risky asset with a risk-off framework, supported by its distinctive properties. If you enjoyed this video, please drop a like and consider subscribing. We hope to keep you ahead of the financial curve.